Somewhere, right now, a number is moving, quietly, almost unnoticed, on a chart most people never look at. But that number has broken every single bank's balance sheet before, and it's happening again. The Federal Reserve is not in control of this. No interest rate decision, no press conference, no policy statement can stop what's coming next. Because this time, the problem isn't inflation, isn't the stock market. It's something older, something bigger, hiding inside the bond market itself. And by the end of this video, you will understand exactly why gold and silver are not reacting to the Fed anymore. They're reacting to something the Fed can't fix. Stay until the end, because the final part of this story is the part almost nobody is talking about. Welcome to Currency Arc Insight, the channel where we break down the economic forces shaping global markets before they make headlines. If this is your first time here, subscribe now so you don't miss the next warning sign we uncover, and tell us in the comments, where in the world are you watching this from tonight? For most people, the bond market feels distant. It sounds technical, boring, something only bankers and economists need to understand. But what happens inside that market right now is quietly rewriting the rules for gold and silver, and almost nobody outside of Wall Street is paying attention. To understand what is coming, one must first understand something simple. When interest rates fall, older bonds become more valuable. Investors want them because they pay more interest than the new bonds being issued. This pushes bond prices up. This is exactly what happened for 40 years, from 1980 all the way to 2021. Interest rates kept falling and bond prices kept climbing. Investors who held government bonds during that stretch enjoyed one of the greatest bull markets in financial history, and very few of them even realized it. But every long trend eventually turns, and this one has turned too. Since 2021, interest rates on government debt have started rising again, even as central banks cut their target rates in an attempt to control the economy. This is the part that confuses most people. Many assume that when a central bank lowers rates, borrowing costs across the board should fall, but the bond market does not always follow that script. When investors lose confidence in long-term debt, they demand higher returns to hold it. That pushes yields up regardless of what the central bank wants. Rising yields mean something very specific for existing bonds. New bonds now offer better returns, so the old bonds, the ones issued years earlier at lower rates, lose their appeal. Their prices fall. This is what analysts call a bond bear market, and it is exactly what has been building since 2022. This may sound like a distant financial detail, but it has already caused real damage. In 2023, several regional banks in the United States collapsed almost overnight. The reason was simple, even if the news coverage made it sound complicated. These banks had taken customer deposits and used the money to buy long-term government bonds, expecting a safe and steady return. When depositors wanted their money back, the banks had to sell those bonds. But the value of those bonds had fallen because of rising yields. The banks could not raise enough money to cover what they owed, and they failed. This was not a small event. It exposed a fragile system that many believed was untouchable. Here is why this matters for gold and silver. For decades, government bonds have been seen as the ultimate safe haven. When the stock market crashes, money is supposed to flow into bonds because they are considered stable and secure. But if bonds themselves are unstable, if they are the source of the fear rather than the shelter from it, then the entire old playbook breaks down. This is not the first time history has seen this pattern. Between 1973 and 1975, the world experienced a similar bond bear market alongside a serious stock market decline. Instead of falling alongside stocks, gold moved sharply higher. Investors abandoned both stocks and bonds and turned to something outside the financial system entirely. That period remains one of the clearest examples of what happens when the usual safe havens stop behaving safely. Today, the conditions look strikingly familiar. Bond yields are climbing. Confidence in long-term debt is fading. And the very structure that once protected investors during a crisis may not be there to protect them this time. This raises an urgent question for anyone watching the markets closely. If bonds can no longer be trusted as the safe harbor they once were, where does capital go when the next storm arrives? The answer to that question is where this story turns next, and it begins with a banking crisis that most people have already forgotten. Every financial system runs on trust. People trust that their bank will return their deposits. Banks trust that the assets they hold will keep their value. And for generations, everyone trusted that government bonds were the safest asset on earth. In 2023, that trust was tested, and in some places it broke. The story begins with a simple business model that banks have used for decades. Customers deposit money. Banks take a portion of that money and invest it in assets that are supposed to be nearly risk-free. Government bonds have always been the top choice. The logic made sense for years. Bonds paid a steady return, and their value rarely moved by much. But that assumption depended on one thing staying true, and that was low and stable interest rates. When interest rates began climbing again, the value of those older bonds started to fall. Banks that had loaded their balance sheets with long-term bonds bought during the years of ultra-low rates suddenly found themselves holding assets worth far less than what they paid. On paper, this did not seem like an emergency. As long as nobody asked for their money back, the bank could simply wait for the bonds to mature and get repaid in full. But that is exactly what depositors did. Word spread quickly that a handful of banks were sitting on massive unrealized losses. Nervous customers began pulling their money out, and the banks had no choice but to sell their bonds early to cover the withdrawals. Selling early meant locking in the losses instead of waiting them out. Within days, some of these institutions collapsed entirely, wiped out not by bad loans or fraud, but by a bond market that had quietly turned against them. This was more than a story about a few unlucky banks. It revealed something far more important. The very asset that regulators, economists, and investors had treated as untouchable for generations had become a source of danger. If banks holding trillions of dollars in government bonds could be brought down this quickly, then bonds were no longer the guaranteed safe harbor everyone assumed them to be. This matters enormously for anyone thinking about where money runs to during a crisis. The traditional playbook says that when stocks fall, investors rush into bonds for safety. That playbook was built during a 40-year period when bond prices mostly moved in one direction, and that direction was up. Nobody alive in the modern financial industry had truly experienced what happens when bonds fail to protect anyone during a real crisis. History, however, has already shown what happens when this exact situation occurs. Between 1973 and 1975, the world faced a similar environment where bond yields were rising and the stock market was also under pressure. Investors could not hide safely in either one. Stocks were falling and bonds were losing value at the same time. Faced with nowhere else to turn, capital moved into gold. It was not a small move either. Gold rose dramatically during a period when nearly every other traditional asset was struggling. This pattern is worth remembering today because the conditions look eerily similar. Interest rates are climbing again after decades of decline. Confidence in long-term government debt is being questioned. And the banking system has already shown in real time just how exposed it can become when that confidence slips. The events of 2023 were not just a warning about a few banks making poor decisions. They were a preview of a much larger problem building underneath the surface of the entire financial system. If bonds cannot be trusted to hold their value during stress, and if banks themselves can be destabilized by that same stress, then the search for a genuine safe haven becomes urgent. This is precisely where the next chapter of this story begins, because history has already given a clear answer about where capital goes when both stocks and bonds fail to protect it at the same time. History rarely repeats in exact detail, but it often rhymes closely enough to notice. What happened in the 1970s, when bonds and stocks both failed to protect investors, appears to be unfolding again in a modern form. The years between 2022 and 2025 have produced a pattern that closely mirrors that earlier era, and gold has responded in a way that deserves serious attention. By 2024, gold had done something it had not managed to do in its entire trading history. It broke decisively above the $2,000 mark and kept climbing from there. For years, that level had acted as a ceiling, a point where gold would rise, stall, and fall back. This time was different. The breakout did not happen during a moment of panic or a sudden crisis headline. It happened gradually as bond yields continued climbing and confidence in long-term government debt continued eroding in the background. Then came early 2025, a period that offered a real test of the theory. Concerns over trade tariffs triggered a stretch where the stock market fell for 3 consecutive months, the longest losing streak in recent memory. Under the old rules, investors would have expected money to rotate into bonds during this kind of stress. Instead, gold rose during every single one of those 3 months. In March of that year alone, gold posted one of its strongest monthly gains in years, climbing sharply at the very moment the stock market recorded one of its worst months. This was not a coincidence. It was the same pattern seen in the 1970s, playing out in real time, in front of an audience that mostly was not watching closely enough to notice. What makes this moment different from a typical market cycle is the second half of the equation, the part involving the banking system itself. When bond yields rise too far, the losses sitting quietly on bank balance sheets grow larger. Those are the same unrealized losses that triggered failures back in 2023. If yields continue pushing upward, past a certain threshold, banks could once again find themselves in a position where those paper losses turn into real ones, forcing depositors and regulators into another moment of panic. This creates a very specific kind of pressure on the Federal Reserve. If bond yields climb high enough, somewhere in the range that analysts have flagged as dangerous, the central bank may be forced to intervene, not because of inflation concerns, but simply to stop the banking system from breaking. This is exactly what happened in 2023, when a special lending program was created to help banks avoid selling their bonds at a loss. That intervention helped stabilize the system, and not long afterward, gold began its historic climb past $2,000. This is the critical detail that connects everything together. Gold does not need a stock market crash alone to rise. It also rises when the central bank is forced to step in and rescue a financial system under stress, because that kind of rescue almost always involves expanding the money supply in one form or another. Whether the trigger is a market crash, a banking failure, or an emergency intervention, the outcome for gold tends to look the same. This is why the events of the past 3 years cannot be dismissed as random market noise. They form a continuous thread, starting with rising yields, moving through banking stress, and ending with gold pushing to new highs. The pattern from the 1970s did not vanish. It simply waited 50 years for the right conditions to return. But there is one more piece of this puzzle that most people get completely wrong, and it involves a force that many assume should crush gold prices rather than support them. That force is deflation, and understanding it is where this story turns next. There is one argument that keeps coming up whenever gold is discussed, and on the surface, it sounds reasonable. Technology keeps making things cheaper. Manufacturing has moved to countries with lower costs. Artificial intelligence promises to make entire industries more efficient and less expensive to run. If prices for goods and services keep falling because of these forces, shouldn't that be bad for gold? After all, gold is supposed to be a hedge against inflation, not deflation. To answer this properly, one has to look back at what actually happened the last time the world experienced measurable deflation. In 2009, following the global financial crisis, the United States recorded a rare negative reading in consumer prices. According to the simple version of the argument, gold should have struggled that year. Instead, gold rose by roughly 24% and silver climbed by close to 49%. This was not a minor exception. It was one of the strongest years for both metals in modern history, happening at the exact moment official data said prices were falling. The explanation lies in what was really happening underneath the surface. From the mid-1990s onward, cheaper manufacturing and technological progress made everyday goods significantly less expensive. A large television that once cost several $1,000s eventually dropped to a few $100s. This kind of progress should have shown up as falling prices across the broader economy. Instead, overall prices kept climbing almost every single year during that period, with 2009 standing out as the rare exception. The reason is straightforward once it is laid out clearly. Governments and central banks use these genuine deflationary forces as cover to spend and expand without facing the consequences that would normally come with it. Instead of allowing consumers to enjoy the full benefit of cheaper goods through falling prices, monetary and fiscal policy absorbed those gains and redirected them elsewhere. The money supply kept growing, government spending kept rising, and central bank balance sheets expanded dramatically during moments of crisis, first in 2008 and again in 2020. This matters enormously for understanding what artificial intelligence might do to prices going forward. If AI genuinely makes goods and services cheaper, history suggests that this will not translate into falling prices at the register. Instead, it is likely to give governments and central banks even more room to spend, borrow, and expand the money supply without triggering the kind of inflation that would normally force restraint. In other words, the deflationary benefits of AI are unlikely to reach ordinary consumers directly. They are far more likely to be absorbed by policymakers who use that breathing room to keep expanding. This is precisely why gold does not respond to inflation in the way most people assume. Gold responds to the expansion of the money supply itself, regardless of what is happening to consumer prices in any given year. Central banks around the world appear to understand this better than most individual investors do. Since 2010, central banks have been steadily increasing their gold reserves, quietly reducing their reliance on the US dollar as their primary reserve asset. This shift began shortly after governments started creating enormous amounts of new currency in response to the financial crisis, and it has continued ever since. Silver fits into this picture as well, though through a slightly different path. Beyond acting as a monetary asset alongside gold, silver plays a critical industrial role in modern technology, including the very artificial intelligence systems that are expected to drive future deflation. This dual role, part monetary hedge and part industrial necessity, has kept silver prices from falling below certain historic floors for nearly 2 decades. Taken together, these 4 parts tell a single connected story. A 40-year bond market has quietly reversed. That reversal has already broken parts of the banking system once, and could do so again. Gold and silver have responded to this stress exactly as they did 50 years ago, rising when bonds and stocks both fail to provide safety. And even the forces that seem like they should weaken gold, such as technological deflation, have historically ended up strengthening it instead, because governments consistently choose expansion over restraint. For serious decision makers watching these signals, the conclusion is not about predicting a single crash or a single price target. It is about recognizing a structural shift that has already begun, and preparing accordingly before the rest of the market fully understands what is happening.